It's almost winter in the inland Northwest. Snow is falling, days are short, and the snowbirds are preparing for their annual journey south. Much like the weather in December, 2021 has been unpredictable and at times harsh. Supply chain problems, labor shortages, housing issues, inflation fears, and of course, another variant of the COVID-19 virus. With all of these challenges, it's easy to forget how much progress we've made this year. We've regained jobs lost during the recession. We've begun to attend games, plays, and social functions. Long-awaited projects are coming to fruition, and more people are discovering what we've known all along. The Inland Northwest is a great place to live, work, and play. At the Journal of Business, we endeavor to keep you, our readers, informed about what's happening in your community. Our staff is dedicated to providing you with objective information on news and trends, with the goal of helping you be more successful on your chosen path. It's time to go beyond the sound bites. It's time for more depth than 140 characters can provide. It's time for elevating the conversation.
Well, good afternoon and welcome to Elevating the Conversation. My name is Paul Reed and I'm honored to be publisher of the Journal of Business. Also honored that so many of you have spent time with us these afternoons all year long for these really important conversations we've been having. We launched this series because you asked us to have a venue in which we could have conversations about important topics facing our community. And we've done just that. We've had a wonderful year. 12 months we've been doing this. We've had great speakers, including Stephanie Curran, Dr. Frank Velazquez, Keantha Duncan, Jim Frank, Steve Scranton, Jennifer Koenig, Gordon Hester, Christine Johnson, Rochelle Strowther, Shelley O'Quinn, and Larry Crowder, covering topics ranging from vaccinations to DEI to workforce and housing shortages and many more. And we have a great lineup of topics for next year already. Check out our website at SpokaneJournal.com/events and you'll see them all listed there. We hope you join us. First up next year, we've got Brian Fix of Providence Healthcare, Washington, Montana, talking about talent acquisition in a post-pandemic world. But today, I'm very pleased to have with us Grant Forsyth, Chief Economist at Avista Corp, for a discussion about the business outlook in 2022 and beyond. Let's face it, everyone is hungry for more knowledge about what the economy might be doing in the coming year. And we've got one of the best economists in our region here with us today, so I can't wait. But before we get to that, I want to thank Eastern Washington University for sponsoring this month's Elevating the Conversation. We do not get to do these things without the great support of some wonderful organizations, and EW is certainly among them. We're going to show you a quick video from EW, kind of showing some of the excitement going on out there, and we're going to follow that with a personal welcome with none other than Interim University President, Dr. David May. Welcome, Dave, and go Eags.
10 years ago, people were still calling cabs. Your house wasn't a hotel, and self-driving cars, mostly wishful thinking. We don't know where the future will take us, but we do know the challenges the future presents will not be one-dimensional. So we are rethinking everything. At Eastern Washington University, the new think sends your school, back to the drawing board, and tears down silos along the way. Here, data science hangs with sociology to turn analytics into action. And geology joins forces with robotics to explore innovative solutions for climate change. Urban planning and public health? Yeah, they're talking. But this is so much more than talk, because we are doing. Biologists are harnessing gut microbes to build stronger bees. Composers are writing music to help us understand how salmon migrate. And disability studies works with Africana studies to ensure villages halfway around the globe have access to clean water. Doors are opening, and it is all hands and all minds on deck. At Eastern, we don't wait for the world to change. We stay out front. We get up early, red up the turf, and run up the score. It's not just about thinking differently. It's about learning for the way things are now and the way the world's going to look another decade from now. An interdisciplinary education that gets real about the real world, that's the new think. It isn't a tagline. It's a philosophy wrapped in red and white. It is Eastern Washington and you.
Thank you, Paul, for the opportunity to welcome everyone to this forum. And Eastern is very proud to be a sponsor. All of us here at Eastern Washington University are thinking a lot about the future, about 2022 and well beyond. What's next and how do we prepare? What we did yesterday maybe isn't what we need to do tomorrow. Like every part of our society, we will have to adapt to a future that we can't see very clearly yet, and we'll have to do it quickly and in real time. Jobs that don't yet exist and technologies that will probably blow our minds. For us here, that means creating new ways of teaching and learning, career-connected and experiential learning. It means programs of study that are responsive to the needs of our students and to the needs of the regional workforce. Fortunately, as you just saw in that amazing video, we aren't just talking about the future. Eastern Washington University is stepping boldly into that future today. We are already becoming the new you, and we're ready to continue to partner with our region well into the future. Go Eagles.
Thank you, Dr. May, and thank you all for joining us today. Good afternoon on a Thursday, snowy Thursday afternoon in the Inland Northwest. No surprise in December. It's good to see you, Grant.
Thank you. Thank you for having me.
It's, we talk a time or two a year at least, but it's been a while since I've actually seen you. So,
well, it is strange to associate with people again.
Yeah. Well, we've got a lot to unpack this afternoon if we're going to figure out what's going to happen in the future. So let's start with jobs. It seems like everybody's talking about labor shortages and supply chain issues across the board.
Right.
And so I think jobs would be the best place to start today. We've seen a recovery of the jobs that we lost during the brief recession. How would you characterize that market right now?
Well, it is true. We have largely recovered regionally from where from that big decline that we saw at the beginning of 2020. But the problem is the labor market still remains highly unsettled. You just have a lot of turnover going, and it's not. I mean, you can look all around the U.S. and what you see is just a lot of people turning over jobs, looking for perhaps a better job, given the fact that there are maybe more opportunities than there have been in the past for people to make a career change.
Sure. So in terms of total jobs, where are we now and where do you expect us to be in the new year?
Well, I mean, this year, again, we'll be back to where we were level in terms of
total jobs.
Total jobs for February 2020. It's highly uncertain. The job growth picture is going to be difficult to predict in 2022 because we have this big elephant out there called COVID.
Sure.
And COVID continues to, again, create problems in terms of the economic recovery. I really see growth probably in the 1% to 3% region.
Sure.
For employment growth. But again, that is going to depend a lot on how COVID materializes.
Sure. When you talk about 1% to 3% in this context, that's a very large range. What is something that would happen that would put us at the top end of that, the more optimistic end of that range?
Well, the main thing is that if we get through the Omicron variant and we don't see another variant pop up again.
Sure.
Right. Because it's COVID that's keeping things kind of roiled, unsettled. If we can really get the virus under control, so we're really pushing it towards that endemic stage from the pandemic stage, that's what's going to get us to that 3%.
Sure.
But there are some drags along, and one of the big news that came out this week that's going to be one of those drags is the Fed has indicated they're going to push rates up faster than what they had initially been saying just a few months ago. Sure. And that's going to act as a drag on demand if they do 3 rate increases in 2022.
Sure. And so how do those rate increases relate to jobs specifically?
Well, it's going to suppress things like investment. So as interest rates go up, the cost of money goes up. And so you're going to see perhaps a slowdown in the housing market, which has been a big driver of a lot of economic activity.
Sure.
You might see firms maybe slow down on investment activities. That can also affect ultimately employment levels.
Sure. And then when we talk about the upper end as well, I guess what I'm asking is there a possibility that we're not going to see
those interest rate hikes? What would dissuade the Fed from following those?
You would have to see a dramatic fall off of inflation, because that's the primary thing. Their hand is being forced by the fact that inflation is not nearly as transitory as they had hoped.
Sure.
Right. And so they're going to pull some levers to try to slow demand growth, to try to slow inflation growth.
Sure.
Right. And at this point, unless we see a dramatic fall off of inflation, and given the fact that you still have supply disruptions, I don't think that's going to happen. I think the Fed's going to move ahead. I mean, 2 for sure, but 3, I still think is highly probable based on their statements.
Sure. So let's move into supply chain issues real quick. It's a tough issue to get your hands around because it's not clear what exactly is causing it. We're all picturing our stuff sitting on boats outside on ports.
There is some of that. I mean, there's issues with containers. There's issues at ports. Some of it has been created by COVID itself and the ability to quickly work closely together. That has constrained some port activity. But as it turns out, it's also complicated by the bubbly labor market we've got. I mean, you have a lot of people who are supply producers. They're producing inputs for somewhere downstream, and they're struggling themselves to find people to ramp up production.
Sure.
But there's some other complications that have cropped up, and this was unanticipated. It's not related to COVID, but it involves Asia, and Asia is a major supply source for the world. And one of the things that's happened is that many provinces in China, in order to meet emission targets set by the central government, have periodically switched off power.
Sure.
Right. And well, no power, no manufacturing activity, no supply activity.
Sure.
Right. You also have the situation where China is having a trade dispute with Australia. That's affected coal supplies flowing into China, and coal is a major source of electricity generation.
Wow.
So you've got these other things layered in there that are making the COVID disruptions even worse.
Sure. And those are things that obviously we can't do anything about here.
Yeah, I mean, it's
in Spokane.
Yeah, the Fed doesn't have control of them. The Biden administration doesn't have control of them. Congress doesn't.
Sure.
And so we're kind of at the mercy of policy decisions in other regions that we're really dependent on for the flow of goods and services.
When you talk about the emissions regulations by the Chinese government, is that new news to a lot of people? That's something you don't hear a lot about.
No, I was quite surprised and actually read about it the first time in the news magazine, The Economist, which is kind of my favorite source of information. Yeah. And so that's where it first came out. And so it was, I think, a surprise to a lot of people that this was occurring. I think maybe they've tried to sort of lessen that now, because they can see how disruptive it is, but it's still the case that these provinces are under some pressure to control emissions. And for them to do that, in some cases, the only way they can meet those targets is to essentially flip the switch.
Sure.
And so in the end, it's up to the Chinese central government maybe to show more flexibility on those targets. Whether they will, it's hard to say.
Right. I wanted to mention real quick, I have a lot more questions for Grant, of course, but we have a question and answer feature within our Zoom where you can ask questions at any time. And when we finish our conversation, we'll go through as many of your questions as we can get to. So feel free to start letting those flow in anytime. I wanted to ask one other thing about the supply chain issues. One thing that I haven't reconciled in my mind is how much of it is raw materials and how much of it is finished products.
It's a good question. My sense, reading, talking to people, a lot of it is more getting the raw materials in to do the finished product.
Sure.
So the classic example right now, and it actually has a big impact on the economy because it's a major force in economic activity in the U.S., is auto manufacturing.
Sure.
So of course, one of the big problems is finishing off the cars because they don't have the chips, right? Because the majority of the chips are being produced in Asia, and you have those supply disruptions we've been talking about. Right. And so a lot of it is this lack of raw materials to finish the finished product to get it out to the marketplace.
Yeah. That's what you'd expect. We've had a large emphasis in recent years on doing more manufacturing in the U.S., and you just wonder if some of this supply chain issue will redouble some of those efforts or have some sort of influence on those efforts?
I think it will. And you're starting to see, I think, some discussion of maybe increasing the supply chain that's based in Mexico,
Sure.
right?
Sure.
And because then you're less susceptible to those long distance supply chain issues that we're seeing right now. You're also seeing people discuss more about rebasing some of that in the US, but again, it's not a short-term solution, it's a long-term solution.
Right.
And even if you're going to rebase a lot of that in the US, you're going to have to accept the fact that our costs are higher. And so you have the safety of it being based in the US, but you have the cost side, you're going to have to pay for that probably.
Right. Right. Yeah, we've already seen some Spokane area manufacturers put more emphasis in, or an emphasis in Mexico and other parts of Asia when the trade war was at its height in between U.S. and China. Is that still an issue for us, by the way?
Yeah, I mean those issues are still hanging out there, and and we did see, for example, as the trade war heated up under President Trump, you saw the shift in activity to places like Vietnam, the Philippines, right?
Sure.
And I still think those trade issues are hanging out there. We don't have full resolution of them, and we're likely to see some additional ones. We now have some tension with Canada over our desire to essentially provide a tax benefit to people who buy US-made EVs, when you also have EVs being made in Canada.
Mm-hmm.
So and now, as my understanding is, Mexico is not very happy with that either.
Right.
And so we're still in this weird thing where, in addition to COVID, we have these outstanding issues, and they don't seem to be easily resolved.
Yeah. And it's interesting because we've mentioned COVID a time or two, and a lot of these issues that we talk about with labor and supply chain, I think what we've learned as the pandemic has matured is that COVID had an influence on them, but these were issues that might have been here regardless of whether we had a pandemic.
Exactly. And we have some other issues. We still live in a world, and this is just an example, that's geologically active. I mean, we could have situations in China on the West Coast where you have an event that continues to cause supply chain disruptions. Right. And so what I'm hoping is that people begin to look at this situation and ask the question, especially for the US, how do we need to think about redesigning the supply chain so that we have a little bit more resiliency? Because it's those supply chain issues that have also surprised us with this inflation, which is also causing some issues.
Geologically active, like we don't have to worry about already.
Exactly. Right. Well, I'm an economist, so I always like to look at the darker side because you always need to think about what's the next worst thing that can happen. But I think COVID has raised an important issue about how the supply chain has been set up. Even though it was highly efficient and low cost, we see that it has vulnerabilities now.
Sure. And I wonder if we've seen so much of an emphasis put on lean practices, which have benefited companies across sectors.
Right.
And maybe we're seeing one of the downsides of that.
Well, and I think it's true. I mean, so somebody pointed out, just-in-time manufacturing is really hard under these conditions, almost impossible.
Sure.
And so the question is, what's plan B if you can't run that anymore?
Right. Well, let's talk about inflation again real quick. You brought that up, and it was something that it seems to be a subject that you see different opinions on how big of a concern it is. And so where do you fall on that spectrum?
Well, I will admit that when this first started ramping up, that is the rate of inflation, I was definitely in the Powell camp that this would be transitory. Now, we can get into this issue about what transitory is. It's definitely less transitory than I had expected.
Okay.
Right. And part of that is the depth of the supply chain issues I just simply underestimated.
Sure.
And we can continue to see that those problems are impacting prices. My guess is, this year consumer inflation will be 4.5%, 5%.
This year being 2021.
2021, 2022, if you look at a broad range of forecasts, we're, in that maybe 3 to 3.5% range.
Sure.
And so it's not until 2023 where you start to see people expect to see the inflation rate coming down to something closer to the Fed target of 2%.
Okay. And I'm wondering, so one of the arguments that you see every once in a while is that there are a couple of categories that are skewing the overall
Right.
inflation. Is that the case? And,
Yeah. So let me just, I looked at this today because the inflation report came out just recently.
yeah,
And
sure.
I had to write this down because
Right.
it's, it's a little bit complicated. But so if you just look at the rate of consumer inflation for all items, and just bear with me here,
Sure.
less food, shelter, energy, and used cars and trucks,
Okay.
right? Okay, on a year-over-year basis, comparing to the same month last year to now, the inflation rate is about 1.8%,
Okay.
right?
Okay. So one more time, if you take out food,
Shelter, energy, and used cars and trucks,
okay.
okay? If you just look at that range of commodities, and that's a whole bunch of stuff, even though you're leaving a few things out, it's about 1.8% year
Okay.
over year, okay? But if you look at the overall index, I mean, you put everything in there, including the things that we initially took out of it, the inflation rate was 6.8%.
Right.
So what that means is you have a lot of things concentrated in food, right? Shelter, in particular, rental prices have continued to escalate at a pretty good pace in a lot of areas.
Right.
Energy, on the energy side, the thing that's really rising on the energy side is really fuel, right? So it's
Sure.
fuel oil, but also gasoline.
Right.
That's a big component of this, right? And used cars and trucks. And in fact, you could throw new too, but used cars and trucks are definitely having a big impact. I mean, if you look at their contribution to that 6.8%, it's not trivial.
Yeah.
And so it is focused in some areas. The problem is, though, some areas people still need to buy,
Right.
right? And that's causing the grief.
Well, that's exactly right. I mean, the average person, I mean, I'm sitting here thinking, yeah, great, that's everything I have to spend money on. So,
Well, I know exactly. And but here's the thing. So the Fed is going to raise rates to try to get that inflation down a bit. Well, the problem is the Fed is probably going to, what they can do is raise rates to kind of decrease demand.
sure.
And demand is having an impact in addition to supply constraints. But the kinds of things the Fed can do won't necessarily impact the supply constraint issues that are causing inflation to accelerate,
Right.
right? The only thing that's going to really fix a big part of that is, again, sort of righting the economy through getting COVID under control, right? So the Fed's ability to quickly bring down inflation rates by raising rates will be somewhat hamstrung by the fact that those rate increases aren't fixing all of the factors associated with inflation.
Sure. Sure. Now, one of the things that I was curious about in regards to inflation is we've heard talk about a post-stimulus economy. And even when we saw the tax breaks during our tax incentives during the Trump administration, we talked about a little bit of a spike and then a normalizing, kind of coming off of, I think Steve Scranton would call it a sugar high, right?
Yeah, that's exactly. Yeah, he does.
And so I wonder when the economy is not being infused with all this money from the federal government, is that going to do anything for inflation or?
Right. I mean, I think the big fiscal stimulus. So there's two types of stimulus.
Right.
You have fiscal stimulus and monetary stimulus. And we had a lot of both at the start of the pandemic. The fiscal stimulus is over, and that has probably already started to wane in terms of its impact on demand, people's demand for goods and services. The monetary stimulus will be ending, right? In fact, it's really starting to trail off now. And so what we're looking at is those stimulus things that were kind of pushing demand in the country up. At the same time, we had these supply constraints. That some of that demand is going to start to ease back over the next 24 months.
Sure.
Right.
Sure.
And that's going to help probably bring down some inflation, but not all of it.
Right. Right. Wow. So if I were listening to this, everything we're talking about is completely out of my control. Right.
Yeah.
So, and it's also not exclusive to our market, really. So is there anything that you see that will affect the Spokane Coeur d'Alene market more or less than anything else that we've talked about?
One advantage that we have as the stimulus starts to wane, one of the advantages we have in terms of continuing to keep demand strong in the region for goods and services is this in-migration of people,
Sure.
right? I mean, if you look at population growth over the last decade, it's really largely been driven by people moving here, not babies being born,
Right.
right? And that's
Sure.
the thing. And that's what I tried to emphasize when I gave the forecast at GSI, along with Steve Scranton and some others,
Sure.
is that, we've kind of gotten used to having a lot of people move here, strong population growth, which has produced a lot of economic activity.
Yeah.
Right. And so the thing we have to worry about is that for some reason people stop coming here, because if that happens, the natural rate of growth, which is births less deaths,
Sure.
is pretty low. I mean, the
Right.
population growth would be dramatically lower than it is now.
It's still a
probably.
net positive, right?
It's still in the
Yeah.
positive, but it would be something around, let's say, 0.4, 0.5%,
Sure.
right?
Sure.
And so that's the main thing. We're really getting a big boost in activity here from an economic point of view because people continue to move here. Now, of course, that's had some, side effects of increasing home prices and so
Sure.
forth, congestion, but it's also produced a lot of increase in demand.
Right. But it's not, and please correct me if I'm wrong, but that percentage growth that you're talking about for Spokane County, it's been pretty consistent for the last 10 years or so, correct?
No, what happened is typically, and this is what made the pandemic-induced recession so different. Typically, when there's a national recession, we'll go into recession too. And when that happens, in-migration slows and our population growth slows notably,
Sure.
right? The only time it really didn't happen was the 90-91 recession,
Okay.
okay? And so that's what made this pandemic so interesting, is that you would have thought the pandemic would have caused people to stop moving around because of the lockdowns and that kind of thing, because we saw that in other countries like China, but that didn't happen. And in fact, to some extent, moving around seemed to pick up, especially into our region. And so it hasn't always been super consistent. Following the Great Recession, because of the unemployment effects, our population growth in the region fell to about 0.5% for quite a while.
Sure.
And it wasn't until we started to recover, we had more jobs, there was a reason to move here, that we saw that population growth pick up again.
Right. But 1% growth, which is what the OFM
Right.
projects for this year, is not extraordinary.
It is compared to the US, and that's the thing. I mean, if you
Sure.
look at the US as a whole, it's between 0.3 and 0.4%.
Sure.
And the pandemic probably depressed births, so it's probably going to be even lower for a few more years than that. So relatively speaking, we're growing a lot faster. And you have to remember, 1% is a compounding number, like we think about in finance. And so 1% over 10 years, you will notice a difference.
Okay, great. Let's see. Just wanted to remind you to please consider giving us your questions for Grant. I know he'll appreciate them, as will we. You mentioned population growth, and I mentioned Spokane County, but the population in Kootenai County is growing at an even faster rate.
Yeah, about 3% in 2020, which is huge.
Yeah.
And they can, and in the forecasts that I use for my work at Avista, you see them at a pretty robust growth rate. I mean, in terms of the forecasting service that we get really for the next decade. And so there really will be a transformational effect in terms of how that region looks in North Idaho over the next 10 years.
Sure. Have you seen anything that answers the question of why you've seen that type of growth in North Idaho?
Well, some of it is people who are coming from more congested areas. They want to retire someplace where you have both access to healthcare, but life's maybe less complicated.
Sure.
So you see some of that. But I also just think there's been a lot of economic growth. There's reasons for people to move there as younger people and establish households,
Right.
and have a career there. And so it's multiple things. I mean, if you look at IRS data for the region in terms of, the IRS tracks movement around the US, not everybody moving here is a millionaire. It's pretty obvious that you have people moving here that are not super wealthy, which means there are things about the area that are attracting people here to establish family households.
One part of the title of our event today is "And Beyond." So as you look over the next 2 or 3 years, or however far you want to look, what are some of the factors that you think are going to influence our economy?
Well, I definitely think what COVID has demonstrated is that Americans still have an insatiable demand for healthcare.
Yeah.
Right.
Sure.
And so I think one of the things that's between demographic changes, the impact of COVID, people moving here, I really see the region's healthcare system continuing to be incredibly important in both terms of employer and also in terms of providing a quality of life that's attractive for people to want to move here.
Sure. Sure. And what are some of the other things that might influence us beyond what we've talked about thus far?
Well, of course, there's this whole change in work. I mean, I think the region, I think traditionally the region has been a pretty conservative economy, traditional economy in terms of how we think about work. But I think increasingly, if certain types of firms want to be successful, they have to consider this more flexible work schedule. And it's interesting if you look on LinkedIn, and sometimes I'll check out LinkedIn to see, sort of what's happening in the labor
Not looking
market.
for Economist jobs.
Right. Yeah. It's not like there's like 10,000, or anything, but just generally, it's interesting how many of those postings now carry the remote word next to them.
Interesting.
And so we've kind of reached this critical mass, I think, in terms of employers willing to consider remote work, that it's really hard for other employers to really completely rule that out going forward.
Sure, especially for certain types of jobs.
That's right. And that means that, you can begin to attract people here who are working for organizations that are not based here at all.
Right.
Right. And it also potentially changes things like commuting patterns and how we think about designing transportation infrastructure for the region.
Right. Right. Fascinating. And you wonder if it'll have a long-term effect on office space.
Yeah, and not just office space, but how are those offices designed? I mean, is it just hotel space, or do you have an assigned cubicle forever, or is it something where you just come in and reserve space when you need it? I mean, you're starting to see some trends emerge, I think, in terms of how offices might be set up, but definitely in terms of the commercial side of things, I would imagine it would change a little bit in terms of how things get built or how things get designed in the long run.
Yeah. One thing I've heard you talk about before, Grant, that I wanted to touch on today is the political climate in our country and its effect on the economy. And the way you've talked about it in the past is not really pointing a finger at one party or another, but just the general discord and inability to work together. Could you touch on that?
Yeah. One of the problems the U.S. has right now and is we no longer have a central governing coalition. So when I was growing up in Ellensburg, you had, two parties, Democrat, Republican, and within that you had kind of centrist Democrats, centrist Republicans who had this really good center. And what you got out of that was policy being made, and you also had more policy consistency.
Sure.
Policy tended to stand the test of time a bit more. Now what you have in the US, and I've said this many times, and nobody has come after me yet for it, but we really have four parties right now. It's almost like a parliamentary system. We have two parties on the left, you've got two parties on the right, and even certainly they can't agree across those lines, but even within their own left and right parties, they can't agree.
Sure.
And so it becomes very difficult to get policy or get any kind of policy consistency that in particular businesses can depend on as they're planning for the long term.
And that's the one thing that generally speaking, business asks for out of its governments is consistency.
Right. I mean, you may not love the policy that finally gets handed down to you, but if it's going to change every 2 to 4 years, it makes it really hard to plan for the future versus, okay, maybe I don't love this policy, but if I know it's going to be in place for the next 10 years because I have a stable governing central coalition that can make these things stick, my life's in some ways maybe going to be easier.
Sure. Interesting. Is that something, crystal ball question, but is that something that you can see changing anytime soon?
Not in the next couple election cycles. I don't see that changing. In fact, when you get to the midterms, if you see a situation where the Republicans are able to retake the House or Senate, or both or one, you're going to continue to see some uncertainty about where the direction of things like tax policy is going to go. Other types of fiscal policy, it's just going to remain uncertain. And then after that, 2 years later, we have a presidential election.
Sure.
That could shake things up again. It's just a situation where every time you have a change like that occur, the new style is to kind of purge
Right.
what the previous folks were doing. And again, that's leading to this kind of whipsaw activity and policy that I think sometimes makes it hard for businesses to kind of say, okay, this is how I need to set up my business for the next decade.
Sure. Let's see. Are we ready for some questions yet?
Yes, our first question was from Greg Francis, and I think it's probably been answered. Had to do with how we manage supply chain in the future, onshoring. But Greg, if you'd like more dialogue on that, please let me know in the Q&A box. We'll come right back to that. Also, question from Richard Rep. Good to hear from you, Richard. California environmental and development regulations have been identified as factors constricting warehousing of shipping containers and contributing to the supply chain issues. 30 to 40% of trade goes through California ports. Is there capacity for Portland, Tacoma, and Seattle to relieve the backup at the California ports?
It's possible, but probably not all of it. And I think this is an issue that's come up just generally about these big urban areas that also are port areas. How are we handling growth management in these areas? How are we handling zoning? And do those things need to be reviewed so we can maybe think about a way to accommodate more onshoring and also more flexible port activity as we try to deal with these supply issues? But I do not think that you can sort of take all of that activity that's in California and simply shift it to these other port areas. They may simply not have the capacity to deal with it. So you just have a bottleneck in a different location.
Thank you. And Lars Gilberts, good to hear from you, Lars. Also, you've talked a little bit about inflation, so I'll paraphrase this a little bit. What might be the differentiators between the kind of inflation we see specifically in our region and that at the national level?
Actually, they're quite similar. One of the things the region has been struggling with pre-pandemic is rents, the cost of rental housing. If you look at the most recent inflation report from the Bureau of Labor Statistics, and you look at shelter costs, in particular rental costs, they're rising rapidly. But that's actually been the case in the region for quite some time. So that is, the region has been experiencing that and is experiencing now like the rest of the US. Food, same thing. So really what you're seeing regionally in terms of inflation is really pretty similar to what's happening to many places in the US. The one exception would be housing. For example, single family housing. This region is growing in terms of the cost of single family housing much more rapidly than other parts of the US. This is a common feature of urban areas in the West, some places in Texas and Florida. So that does differentiate us a little bit because of that growth in home prices. You're so much more robust than you're seeing in other parts of the country.
And from Rose Wysocki, and I apologize if I mispronounced your name, Rose, how will Kootenai growth affect Spokane?
Well, that's a good question. So the thing I always like to tell people in Olympia when they're talking about policy is that you have to understand that Kootenai and Spokane are integrated economic areas. Yeah, there's a border there, but we're really fully integrated. So the growth that you're seeing in Kootenai, one of the things it does is offer a much bigger labor force over time that even Spokane County can draw on. And I think that's one of the important things to point out is that their growth there, because we have this exchange of workers all the time, really in the long run is also a benefit to us in terms of the available labor force. The other thing that's occurring there is, of course, their medical establishment has expanded a lot. Kootenai Medical is really, like the hospitals in Spokane, a world-class facility. We're going to benefit that across borders. So the better the hospitals are here in Spokane, I think it will benefit them on the Idaho side, and likewise for us as their healthcare gets better on the Kootenai side. There's a lot of things that are happening in Kootenai that are also going to benefit us.
And from Bruce Miller, if and when the Fed raises interest rates, how large will the increases be?
It's a good question. I suspect the Fed will start out nice and easy with their traditional quarter point increase. I don't necessarily think they want to raise interest rates so quickly that they shut down a lot of growth quickly. I think they're going to be cautious about this. My guess is their plan, at least for the first 3 rate increases that they're planning for this year or signaling, it'll be about 0.25% each time. Now, what would be interesting is I haven't looked at it recently, but I want to go and look at the futures markets for federal funds, the federal funds interest rate, which is the interest rate the central bank uses as a policy rate. Be interesting to look at that and see what the market is expecting to happen, but I would expect 0.25 point increases.
And from Mark Odegaard, how are you factoring in quality of life in terms of growth? Financial growth is fine, but if we aren't prioritizing people and planet, the growth is meaningless. And what is the outlook for local, small to medium-sized businesses?
It's a good question. So, I mean, I think one of the things that's can potentially deteriorate the benefits of growth that the region is experiencing is the whole issue of congestion, traffic. That's a big issue, right? And so the region probably needs to be fairly proactive in thinking about how we're going to manage this growth going forward so that that situation doesn't become untenable. And you do see that in other communities. Of course, that also, that congestion also affects air quality and some other issues related that can affect health. So we definitely need to be looking at that as well. The issue of growth is complicated. I mean, because there are benefits and there are costs. But I do worry a little bit. The other thing I do worry a little bit about growth is the whole issue of water quantity and quality. And that's another issue we're going to have to pay attention to. We have the Spokane aquifer. It's large, but it's not infinite. And so one of the things I always like to try to throw out in policy discussions is we really need to keep our eye on the water issue, because we can look around the US and see that a lot of regions are starting to struggle with that. And we really need to be careful with that. If we damage the aquifer in some sort of way, we don't manage that resource well, that has some real big negative effects for the region.
Can I ask a follow-up on that? When we talk about this remote workforce, so it conjures this image of a lot of people who work outside of, for companies outside of the Spokane area, but live here. How is Washington's tax structure set up does that benefit us still as in Spokane, or do those people, is that a net negative?
No, I mean, I think when those people move here, even though they're working for an employer that's out of area, they're still going to buy their house here. They're going to buy their food here. They're going to get their medical care here. They're going to shop at small businesses here. Right. And so maybe if their business isn't located here, as maybe it would have been in the past, there are some tax implications to that. But it's also important to realize a lot of their spending is connected to where they actually live.
So because we have such an emphasis on sales tax and property tax, we'll still.
Yeah, I mean, I don't really see the kind of remote worker as really a negative thing.
Sure.
I don't see that necessarily kind of undermining the tax side of things.
Right. Good.
So the other part of Mark's question is whether there's any outlook we can provide for the local small to medium-sized businesses. Anything else to add?
Yeah, I do worry about small businesses for a couple of reasons. COVID has been pretty hard on small businesses, and there's data to suggest that that's been the case. So I think, one of the things is recovering from that is going to take a while. The other thing that I think small businesses are going to struggle with is this rise of online shopping, which I think really accelerated through the pandemic. And so I think that's going to continue to be a challenge for smaller retailers, even specialty retailers, to do well in an environment where people seem to have adapted pretty readily to shopping online.
And from Greg Francis, with the tax cuts of 2017, the feds set the personal tax cuts to expire after, I believe, 5 years. Is that still the case, and might they be extended?
That's a good question. I'm trying to remember that legislation. My guess is that's up in the air at this point because of the change in administration. And I'm sure there's probably some discussion. So if President Trump had won the election, I would have said, yeah, they'll be extended. I'm less sure under the current Biden administration, especially with their need to pay for some of their spending plans. That issue might be more on the table than we would have had President Trump won the election.
And from Rich Hadley, good to hear from you, Rich. There are proposals to reduce hydropower and natural gas in this region. What would be the impact on inflation here and economic expansion?
Yeah, there are several proposals, and both Oregon and Washington are looking at some point in the future, restricting hookups on businesses and residences for gas as a heating source. And in fact, the Seattle Times, there was an article published about Governor Inslee's proposal, and his current proposal, if I get the date right, is for no more hookups on residences or businesses for gas starting in 2034. Right? So what that means is that as we go forward in time, there's a shift towards electricity as a heating source. And so it's possible what you'll begin to see is some upward pressure on energy prices, because gas is relatively cheap as a heating source. It's at this point cheaper than electricity. If you shift towards more electrification, my guess is you're going to continue to see maybe some upward pressure occurring across the country in terms of energy costs, in terms of business costs and household costs. The other thing to consider too is that as we shift towards from gas to more electricity, the issue comes up, what is the generating capacity that we currently have? And do we need to build more generation to meet that electrification that's going to occur? Of course, we have electric cars also. That's going to increase the demand for electricity. And so we're at this kind of interesting point in the energy business where we're looking at probably in the long run, more electricity use. And that means more infrastructure, potentially more generation sources. And the question is, what does that cost? And how does that get passed on ultimately to businesses and consumers?
And a second question from Lars. Thank you, Lars. Are there supply chain challenges likely to shift demand, changing what we buy, or production where we buy in the long run?
I would say certainly where things get produced, I could see that changing in the long run. We have more productivity based in North America, either in the US or Mexico. I can definitely see that occurring. The one thing about inflation is it does cause people to look for alternatives. And so I would expect that as inflation continues to be relatively high, people are going to maybe change their buying habits to try to move away from more expensive goods and substitute towards least expensive goods as best they can. At least that's what we've seen in the past.
And a final question from Rose. Do you expect the housing market to correct after such a rapid rise in valuation?
Yes. And so one of the things we need to pay attention to is that the Fed is going to start to raise rates. I think that will begin to slow the housing market, because one of the reasons the housing market in a lot of regions in the United States, including ours, has been so robust is because the cost of money has been so low for so long. I think people have gotten used to that. And now that we're going to start to see rates rise, and remember, as short-term rates rise, that'll also push up long-term rates. And I think that will begin to slow the market. Will it collapse like we saw in 2007, 2008? I don't anticipate that, but I do anticipate home prices will start to slow.
Well, thank you, Grant. Fascinating conversation, as usual.
My pleasure.
A lot of good stuff coming out of this that I didn't even anticipate. So, so thanks for your time.
My pleasure.
Thank you for joining us today. Drive safe if you're driving. Hopefully you're home and not doing that. Have happy holidays, and please join us in the new year when we talk to Brian Fix with Providence about talent acquisition, another big challenge in our region. Take care, and we'll talk to you soon. Thanks.